Today we're going to create a stock portfolio for beginners that don't really want to take on too much risk. Firstly, if you are in the UK, definitely do this through a stocks and shares ISA. A stocks and shares ISA is a way that we are able to invest £20,000 every single tax year completely tax-free, meaning the money that you gain on that account or any dividends that you get from that account are completely tax-free. So definitely make the most of that as a priority. When I first began and I was a beginner investor and I opened my first stocks and shares ISA, I didn't really know what to put into it. I was very confused. There was such a vast amount of options out there. I heard about things called ETFs, index funds. I knew that you could invest into companies like Apple, but then there were UK companies. Could I invest into US companies as a UK investor? What are these ETFs? What are these index funds? What are bonds? Like, there's so many options and it was so confusing. And then on top of that, not only were there different options, but there are different platforms that you can do these investing things in. You know, you could go to your bank and open an account. There was this company called Vanguard, and I actually started on Vanguard, but now I'm on a platform called Trading 212. And there's pros and there's cons to all of these different platforms. So that is another hurdle that you need to overcome and actually look through the pros and cons and decide what is best for you. If you do want to open an account with Trading 212, I'll leave a link in the description. That link will get you a free share worth up to £100. So hopefully that can begin your investing journey on a good positive note with some money going straight into your account. So what I would say is that this is not financial advice, but if you are a beginner and you really don't know anything about investing and you don't really know about researching companies and picking which companies, which stocks are the best ones to have in your portfolio, I would at this stage completely avoid that. I would stick to these things called ETFs, exchange traded funds, and index funds. So these two things are basically ways that you can invest very simply. Buying an ETF, a particular ETF or a particular index fund, basically gives you a collection, a basket of different stocks in one go. So you can buy an ETF that is basically full of different big American companies. So by buying that, you just buy that one thing, and within that you get exposure to all of the big US companies. You don't need to sit and think, do I want McDonald's? Do I want Apple? Should I add Microsoft? Is this a good investment? You don't worry about that. You simply buy this one ETF and you get exposure to hundreds of different companies. It's as easy as that. So what I'm saying is I would basically avoid picking individual stocks as a beginner until you know you are ready and you want to start researching and following companies. Because if you're going to make sound, logical investment decisions, then that needs to be backed up by your own research, looking at financial balance sheets, doing all of this stuff. And you know what? If you never want to do that, then there's no pressure. You can still be very successful in investing by just buying these ETFs and these index funds that I've just spoken about. The good thing about ETFs and index funds, first and foremost, is that they are diversified. Diversification in investing is seen as this principle that everyone must follow. Now, sometimes when you get further along in your investing journey, you decide that actually diversification is not really the route you want to take. But I think as a beginner and as someone that maybe doesn't want to spend time researching different companies, then diversification is really important, because you can't just randomly pick a company and hope for the best, because that's pretty much gambling. So if you're not willing to put the time in to learn about how to analyze companies, which is absolutely fine, then go down the diversification route and just get one of these really diversified ETFs or index funds and just call it a day. Also, they tend to be very cheap, and that's good as an investor, because the cheaper your investing is in terms of how much it costs you to have these in your investment portfolio, the ongoing charges, the more money that you keep as an investor. And that really adds up over many decades, which is what you want to do. You want to be in this for the long term. You want to be in it for many years and let your money actually start working for you and gaining the power of compound interest. You could make your own portfolio covering the entire world by just having a few different ETFs. So let me walk you through this. The biggest market in the world, the largest economy in the world, is the US. So if you were trying to make yourself a portfolio where you're covering pretty much the entire world, you don't really want to leave anyone out, you want all the exposure possible, then you definitely want exposure into the US market. And one of the most famous ways you can do that is through an S&P 500 tracker, an ETF, an index fund. Now, one of the most popular ones that you can get if you're a UK investor, and this is the one that I personally have on my Vanguard account, is called VUSA. VUSA is its ticker symbol. And VUSA is a type of S&P 500 tracker. There are other companies that provide these as well. So VUSA specifically is Vanguard's offering. They are all pretty much the same, but you can only get certain ones on certain platforms and the fees may vary ever so slightly in these. But essentially, by getting an S&P 500 ETF, you are investing into the largest 500 or so S&P 500. I think it's about 502 now, but the biggest 500 US companies. So when I say the word biggest, I mean the biggest by market capitalization. Now, don't worry about that too much if you're a beginner and that just went straight over your head. Honestly, don't worry. The only thing you need to think about is with an S&P 500 ETF, the biggest American companies. So if you were to name some big American companies, you'd probably come up with Disney, McDonald's, Apple, Microsoft, maybe Tesla, companies like that. And you will be getting exposure to all of those sort of companies and probably many that you've actually not heard of as well, because like I said, it's about 502 different companies. So that's really great. Already you're investing into some of the biggest and most known companies in the entire world and the most successful companies. So you'll definitely want exposure to that market. Now, I just mentioned VUSA as the option for the S&P 500 ETF. There is also IUSA, which I believe is the iShares version provided by a company called BlackRock. And there are also many other ones out there as well. If you open an account on Vanguard, you can only invest in Vanguard funds. This means that you can't buy the IUSA version. You have to buy the VUSA version because that's Vanguard's offering. If you decide to go with a platform like Trading 212, then you get access to pretty much all of the ones available. So you could invest in Vanguard's option, but you could also invest in other companies as well. Like I said, they pretty much all do the same thing. The fees just may be slightly different. And obviously you want the fees to be as low as possible because that means you keep more money as the investor. Let's say that you've decided that you're going to get VUSA. That is going to cover you in terms of the US market. But there are other markets out there, not just the US market. We live in the UK, we have the UK stock market. So you might want some exposure to that. Now, Vanguard, again, I'm going to use Vanguard as an example here just for these funds because it's super simple and super easy. And to be honest, they do offer some of the best funds in the world. But don't worry, you can invest into these on other platforms, not just Vanguard. But you can only invest in these if you do have a Vanguard account. So just be aware of that. So we have an index called the FTSE 100. So that's like our equivalent to the S&P 500, the FTSE 100. Now you'll notice that it's called the 100, not the FTSE 500. And that's because, you probably guessed it already, that is tracking the 100 largest UK companies. Again, it might not be exactly 100, it could be 102, but about 100. So if you invest into an ETF that is tracking the FTSE 100, you are getting exposure to all of those companies. Again, if you try and name some big UK companies, you might come up with a few like Legal & General, Rio Tinto, BA Systems. More are not coming to my head right now, but you get the idea. There are some really big UK companies as well. And if you're a UK investor, you probably want some exposure to the UK stock market. And you can do that through an ETF called VUKE, VUKE. And you've got to remember that these big US companies and some of these UK companies, a lot of them actually, are global companies. You know, although they're US companies or they're headquartered in the UK, they are operating and getting their revenue from all around the world. We don't only see McDonald's in the US, we see it in the UK. We use Apple products in Germany, not just in the US. So I'm just saying that although you're getting exposure to these particular markets, you are kind of getting exposure to global companies. And that's great. So now we've covered the US market and we've got exposure to the UK market. There are still areas of the world that we haven't gone anywhere near. Think of massive countries like China. We haven't got exposure there. And we can do this by getting another ETF in our arsenal. So again, on Vanguard, there is an ETF called VFEM. That's its ticker symbol, and that is an emerging markets ETF. So what are the emerging markets firstly? So the emerging markets, it's a term, and it's given to the countries that are basically experiencing dynamic quick growth. So they're countries that are going under really quick expanding industries, and they are on the path to becoming fully developed countries very soon. They're in that like in between stage. They're really growing rapidly. And of course, rapidly growing things in general, companies, countries, whatever it may be, gain a lot of attention and a lot of investment gets pumped into them. So the emerging markets, there are 5 really big ones. You can think of Brazil, China, Russia, India. There are some European countries involved in that too. But you can just have a look what you're actually getting on the Vanguard website. It's probably on the screen now anyway. But yeah, you definitely want exposure to the emerging markets if you are trying to cover the entire world. And you can do that through VFEM. So now we've covered the US, the UK, and the emerging markets. The only other area that we really need to cover today to get your full exposure is the developed world. But remember, we've already got the UK, and the UK is part of that developed market. So we want to cover the rest of the developed world, excluding the UK. And you can do that through the FTSE Developed Europe excluding UK ETF that Vanguard offer. And the ticker symbol for that one is VERX. So this is going to give you exposure to those countries like France, Switzerland, Germany, all of those ones except the UK, because we've already got that covered. So you're going to be getting companies like Nestle, BMW, all these different massive companies that are within those areas of the world, headquartered in those areas of the world. Now, I'll quickly point out that a lot of these options come both as an accumulating version and an income version. They're exactly the same, them two options. So if you're looking at VUSA, VUSA, and you get the option to have accumulating or distributing, or accumulating versus income, same thing, you basically have to decide whether you want to receive the dividends that ETF pays you, and then you can decide what to do with those dividends, which is like a little income for holding that ETF, or you can go with the accumulating version and you won't get the dividends. It will just be automatically reinvested. If you've got any questions about that, I have made a separate video, so I'll try and link it on the screen now. What you may think is, do you know what? I can't really be bothered to sort that all out, and I don't really want to be buying all of those different ETFs. I mean, there's only 4. It wouldn't be that much of a big deal. But if you didn't want to do all that and you wanted to even keep it more simple than that, you can. The good news is that there are global ETFs. So just one ETF that covers the entire world. Now, Vanguard offer 2 really fantastic options. You've got the VWRL and you've got the FTSE Global All Cap. These are both global options. So you can buy any one of these, just one of them, VWRL or the FTSE Global All Cap, and you'll have exposure to the entire world. There are differences between the two in terms of what you're actually getting and the fees involved. And again, I've made a separate video about that I'll link on the screen. But you could just do that. You could simply just invest into one of those and call it a day and know that you're getting exposure to pretty much every market in the entire world. So let's just think about price. Is it better that you opt to build your own portfolio and you go for the options that I said, or maybe just put the money straight into VWRL or Global FTSE All Cap and don't worry about building your own portfolio? There's pros and cons to both. If you're building your own portfolio, you're getting more control. You can say that I want 50% of my portfolio allocated to the US market, 10% to the UK, whatever. And you can pick exactly which funds you have in your portfolio. So there's an element of control there. If you just pick the one ETF, VWRL or FTSE Global All Cap, that is going to be 100% of your portfolio, unless you decide to add other things, obviously. But there is the lack of control there, because it's not like a jigsaw where you're choosing what you want in there. You are just simply having one option, and that's fine if you want to keep it simple. But I did say there are some differences in terms of fees between these 2 different options. So let's just run through that quickly. The fees, again, are going to depend on the platform that you opt for. So we're just going to look at ongoing charges here. So the ongoing charge for VUSA, the S&P 500 tracker, the US market one, is very cheap. It's one of the cheapest out there. It's 0.07% per year. which is so cheap. This is the one I personally have, and it's one I'm a big fan of. VFEM comes in at 0.22%, so slightly more than that VUSA one, but still relatively cheap. Then we have VOOC, 0.09%. Again, very cheap. And then lastly, in the portfolio that we've just created together, we have that developed excluding UK ETF. And that one comes in at 0.1%. So if you add all of those together, the ongoing charges per year would come in at 0.48%. Whereas if you just got the VWRL, the ongoing charge on that one is 0.22. So 0.48 versus 0.22. You can see that the VWRL option is cheaper here. And then if you were to go with the all cap, it's slightly more than VWRL, but only ever so slightly, 0.23%. Cheaper, but less control. Something to consider there. However, any of these options are going to be super cheap compared to other options out there, to be honest. Vanguard's funds are super cheap. Now, what you could also do, this is also an option to beginners out there, is you could decide that actually you're going to make the decision that you think a particular market is going to do better than another. So you could think, do you know what? I really, really like and use those big US companies, and I know that the US economy is going to, or you think the US economy is going to do great things in the next few years, and you don't really have much confidence in, the UK stock market. That's absolutely fine. What you could do, if that is your opinion and you want to back that stock market more, is you could just buy VUSA. And this is not financial advice, but you could decide just to put 100% of your money into VUSA, and then you could slowly start learning how to evaluate companies, and you could add maybe a few individual stocks that you have more conviction for later on. So you could go with 100% VUSA for now, and then over time you might decide to start buying some Apple shares or some Tesla shares, and just increasing your exposure to particular companies in that way. So you've still got your low cost, your passive, your diversified ETF doing its thing, and then slowly you may want to add some individual companies that you've researched and that you're particularly fond of. Or you could add 85% US market, 85% VUSA, and then you could add the rest in an emerging markets fund. You can really do what you want with this. I'm just trying to give you a guide as to how to start building your portfolio if you're completely lost and confused. If you are already on Trading 212 or you are going to sign up, I will leave a link in the description to the pie that I have created for this portfolio. So the pie that I spoke about, where we're getting the US, the UK, developed excluding UK, and the emerging markets, that portfolio I'll leave as a pie. I have allocated certain percentages to particular markets that I think make sense, but you can obviously change that and just use that as an example. But I'll leave a link to that in the description below. So I really hope this video was helpful. If you are watching and you're a beginner and you have further questions, then feel free to leave them in the comments below. Myself or someone will probably jump on and answer your question. Or if you've got any video suggestions like this one about building a beginner's portfolio, again, let me know and I'll try my best to cover that. I won't even charge to say this, but tea and crumpets.